Hi everybody, my name is Griffin Bridgers. Welcome back to the basics of generation skipping transfer tax. In this part 8, we're going to spend some time looking at the details behind taxable terminations and taxable distributions. These are terms where the definition is fairly simple, but when we look at the why and the how, it becomes a little bit more complex. So even if you think you know what taxable terminations and taxable distributions are, you're going to want to listen to some of the nuances behind those terms in today's video. Now, as always, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So to recap, I want to remind you again, the target audience of this presentation is more the professional dealing with intergenerational transfers of wealth. So if you are an individual who's curious, you may not get as much value out of this because it requires a little bit more background knowledge of the estate and gift and income taxes. But in case you want to follow along in this series, just to recap what we've covered so far, we just left off in Part 7 with some key terms like the applicable GST tax rate, which, as you recall, was determined by the inclusion ratio, which was also determined by the applicable fraction, which in turn was determined by the amount of GST exemption allocated to a gratuitous transfer, typically an indirect skip, in the context that we're looking at this. Now, we're going to look to when the end result of this concept, mainly the applicable rate, applies to generation skipping transfers. So we have our same example as we looked at in Part 7, where we're going to assume that the grantor, a parent, transfers $6 million to an irrevocable trust for their living children and their future descendants in 2022, just to put a timeline on it. Now, in 2022, when this trust is funded, there's no grandchildren of the grantor living at that time, but the trust includes as its class of beneficiaries descendants, including any future-born descendants. So what this means is that there's no skip persons alive yet, but when each future grandchild is born, they instantly become both a beneficiary of the trust and a skip person. So by interest in the trust, we're going to assume that they have the right to receive income and principal of the trust during their life. So what happens? What are the GST tax implications and results in this trust? As I alluded to in the last presentation, a lot of that is going to be driven by how much GST exemption is applied to this $6 million transfer at the time that it occurs, because that's going to drive our inclusion ratio now and in the future, and in turn, the applicable GST tax rate. So we're going to look how and look at the specific events that drive this. The first of which is a taxable termination. So a taxable termination is some event in the future after the trust has been established, at which point the interests of all non-skip persons terminate. Now I'll explain the term interest in a minute and what that means. Now this can be an event maybe by the passage of time, like for example under the terms of the trust. So for example, maybe the trust gives children an interest for life, and at their death it goes to their descendants. So at the point that all children die and the only remaining beneficiaries are skip persons, then that would be a taxable termination, regardless of whether the trust terminates at the time or whether the trust is distributed outright to those skip persons. There's going to be an important nuance there to distinguish a little bit later on. This can also be by the election of a non-skip person. So for example, let's say a child has creditor issues and wants to release or disclaim their interest in the trust in a way that doesn't make them become the transferor. We'll cover that in a few minutes. And after that event, even though the child is living, the only beneficiaries left maybe of their share or the trust itself are skip persons. At that point, that would be a taxable termination as well. And this could also just be for a portion of the trust. So let's assume maybe a child dies, but other children are living, but the terms of the trust call for the trust to be divided at that time, and maybe for a separate share to go to the deceased child's descendants who are then living, all of whom are skip persons when compared to the original grantor of the trust. So what this is also a taxable termination, but just for a share of the trust that's created at the death of the child, and not for the rest of the trust for which living children are still beneficiaries. So the big question is, what is an interest in a trust? In other words, if we have a non-skip person who has a quote-unquote interest that terminates, how do we define that? Well, in Treasury Regulation 26.2612-1E, it's defined typically as a mandatory discretionary current right to receive the income or principal of a trust. So typically, if you have a child who's simply a remainder beneficiary, in other words, they don't have the current right to receive income or principal, then a termination of their remainder interest typically would not be a taxable termination. However, there's an exception to that rule where a remainder interest or a termination thereof does potentially create a taxable termination in the context of a charitable remainder trust or a pooled income fund. We won't dive into that because that's a little bit too in the weeds, but with a taxable termination, why do we care? What's the GST tax implication here? Well, at the time of a taxable termination, regardless of whether the trust continues on for skip persons or is distributed outright to them at the time, then there is a GST tax on the fair market value of the trust at the time of the taxable termination. So what that means is that the applicable rate that applies at that time is multiplied by the fair market value of the trust or portion of the trust for which there's been a taxable termination, which, as you recall, is the maximum federal estate tax rate at that time times the inclusion ratio. So the result is that if the inclusion ratio is greater than 0, there will be a GST tax at that time, and the trustee of the trust is responsible for paying that GST tax. Now, it's important to note that even when there's a distribution outright to skip persons, the trustee in this context is going to be responsible for paying that tax. But it's important to distinguish there between a taxable termination in the form of an outright distribution versus a taxable distribution, which we're going to look at in a few minutes. But jumping back to the trustee's obligation to pay, they also have a filing obligation. You report this GST tax due on IRS Form 706-GS parenthetical T, which is due by April 15th of the year following the year of the taxable termination. Now, practically, if this is done right, you're rarely going to have a taxable termination because you're usually going to be dealing with ways to avoid the GST tax on the occurrence of such an event. So jumping back to our example, this never happens, but for whatever reason, we're going to assume that only $4 million of GST exemption was allocated at the time of the initial transfer of $6 million to the trust. Then 50 years later, in 2072, there's a taxable termination, and at the time, the trust has grown to $30 million, and at the time, the maximum federal estate tax rate has been increased to 45%. Now, because we only allocated $4 million of GST exemption to that trust up front when it was funded, that means that our inclusion ratio is 1/3. Recall, the inclusion ratio is 1 minus the applicable fraction being the GST tax exemption allocated over the taxable value of the transfer. So what this means is that our applicable rate of 45% times 1, or really to restate that, our applicable rate will be the maximum federal estate tax rate at the time of the taxable termination, which is 45%, times the inclusion ratio of 1/3, which gives us an applicable GST tax rate of 15%. What this means is that the GST tax at the time of this taxable termination in 2072 will be $4.5 million under the current law, and that amount will be due and payable by April 15th of 2073. So that might happen well in the future, but as you can see, it's important up front to lock in a full 0 inclusion ratio because that creates a 0 applicable rate in the future if there ever is a taxable termination. Now, we're also going to look at the corollary, a taxable distribution. Now, a taxable distribution is simply any distribution to or for the benefit of a skip person, which is not a taxable termination or a direct skip. So I intended to put a slide in for this and I didn't, but there's really a hierarchy that you walk through to look through for different types of GST transfers. First, you check the box. Is it a direct skip? If not, next you look to whether it's a taxable termination. If not, then you look to whether it's a taxable distribution. Now, the interesting thing with a taxable distribution to a skip person is that it includes a distribution of both income and principal. Now, the big question here is, does that mean there's a double tax on a distribution of income? The answer is no. Code section 164 allows you to take a deduction against your gross income for certain types of taxes paid, state, local, or other federal, and one of the taxes included in that deduction is generation skipping transfer tax on a taxable distribution of income. So there's no double tax if you're a skip person recipient. What we're going to find out in a second is that you have to pay the GST tax and the income tax on that income being passed through, but you're not double taxed. For a non-cash distribution, the amount that's being distributed in this taxable distribution will be the fair market value of the in-kind property at the time of distribution. Now, I'm not going to dive into the income tax nuances where we look at whether we're carrying out a carryover basis or whether we have an election to treat that as a capital gain event. All that aside, all we're looking at in GST tax land is just simply the fair market value of the in-kind property being distributed, which will be the amount of the taxable distribution, at least for that portion of the property, which again emphasizes that GST tax is capturing the future growth of property. So the taxable distribution will be taxable to the skip person who receives it, not to the trust or the trustee like we saw with a taxable termination, but instead to the recipient in this case. And it's reported on Form 706-GS parenthetical D, which is due by April 15th of the year following the year in which the taxable distribution occurs. So, what happens if, for example, the trustee wants to help out the skip person and pays the GST tax on the taxable distribution? Well, in that case, this GST tax payment by the trustee is treated as an additional taxable distribution to the skip person. So there's a concept in tax law about circular calculations where, for example, if an employer pays somebody's income tax on their salary as part of their salary, it creates this never-ending loop where technically the salary is increased by the income tax paid, which increases the income tax, which then correspondingly continues to increase the income tax payable. Well, you run into the same thing here. So it's a bad idea to have a trustee pay GST tax on a taxable distribution, or even to write a trust that requires that. The burden is on the skip person, and burdens of taxation cannot be shifted to another party without creating an additional tax liability relating to that tax burden that was relieved. So there's some general exceptions here, and if you're knowledgeable on the GST tax, you may have been wondering in the background when this first one was going to come up. Well, now we're going to dive into it. Now, this is where it's helpful to know about the gift tax. But for gift tax purposes, if you make a direct payment of medical or tuition expenses of any amount on behalf of somebody else, that payment is not subject to gift tax. Well, we get the benefit of that same exception in the GST tax rules, but it can be deferred until a later date. Usually for gift tax purposes, you can only get this treatment on a distribution from a trust if there was no completed gift to the trust to begin with. But in this case, where we're looking at this, we get the same exception on deferred distributions from a trust, which may not be fully exempt for GST tax purposes. So for example, if a distribution is in the form of a direct payment of a skip person's medical or tuition expenses, that will not be a taxable termination and it won't be subject to GST tax, which is a great way, hint, hint, to deal with a GST tax on trusts that have an inclusion ratio greater than 0. That's a strategy we're going to cover in a little bit greater detail later on. I also remind you, Some distributions or terminations may be more in the nature of a direct skip. This goes back to our hierarchy. With any sort of event like this, you have to look to whether it's a direct skip first, even if it has the appearance of a distribution or taxable termination from an existing trust. And if there's a case, what usually happens is that there is a shift in the transferor at the time of the taxable termination or distribution, which creates a new inclusion ratio at the time of the direct skip. So for example, we're going to assume that a surviving spouse held a general power of appointment over a marital trust for which the marital deduction was taken previously, and there's no reverse Q-tip election here. Splitting hairs, it's because you can't make a Q-tip election where the surviving spouse holds a general power of appointment. But that aside, at the spouse's death, the marital trust assets will be included in the spouse's gross estate. Now, if part of this marital trust is distributed directly to a skip person at the spouse's death, that would be a direct skip and not a taxable termination or distribution. Similarly, if the spouse during life may be released or assigned or appointed part of that marital trust, then that could also be treated as a direct skip at that time and not a taxable distribution from the trust itself. So look to that shift of transferor. It's another thing to keep in mind, but usually you're going to see that shift anytime there is a general power of appointment or any exercise or release of a power that creates a taxable gift of a beneficial interest in a trust. So here's our key takeaways. Once again, to bring this home, I want to emphasize the one constant we're trying to keep here, which is the inclusion ratio. As long as another person, like a trust beneficiary, does not become a new transferor, like I just said, by reason of estate or gift tax applying to the trust, then this inclusion ratio does stay static and does not change. But the other items, as we've seen, are fluid and are determined at the time of the taxable termination or taxable distribution. Those would be the fair market value of the trust or distribution and the fair market and the maximum federal estate tax rate upon which the applicable GST tax rate is based through the inclusion ratio. So, that being said, what's coming? We've got GST exemption allocations and how we do that and the strategy behind it, definitions of GST trust, and the definitions of the estate tax inclusion period, or ETEP. And we'll also dive into the GST tax annual exclusion and how it's a little bit different from the gift tax annual exclusion. Finally, we'll look at valuation issues and a new topic, grandfathered trusts and gallo trusts. So in our long list of definitions that we've covered so far, our glossary, today we're adding taxable termination and taxable distribution. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this Part 8 of the Basics of Generation Skipping Transfer Tax, and I look forward to seeing you in my future content.